Hi folks, George Fokas from Fokas Beyond. What I'm going to talk to you today about is the covered call strategy. A lot of questions I get from students and from the general public is, who is the buyer of our contracts and why do they actually buy our contracts? But before I do that, today's the 30th of January 2012. I've got a stock right now. Now this is not a recommendation. I stress this out to you. This is not a recommendation. But as an example, I want to show you what's available to you right now. A few key things you need to remember is this. The contracts that we create on the US stock market expire every third Friday of the month. One key thing you need to remember is that the contracts that we create don't go a calendar period, folks. Not from the 1st to the 30th, but they expire on the third Friday of the month. Today is the 30th of January 2012. So our contracts that we were to create today would actually go for a 3-week period. So for the next 3 weeks, this is what I'm going to show you what the potential is for you to be able to generate. Think about the time and effort that you're going to take to do this and how much you're going to earn banked into your account up front for your actions. Are you willing to discover how to do this? Another key thing you need to understand is this. On the stock market, we need to purchase stocks in lots of 100, which allows us to create one contract. So we purchase stocks in lots of 100, 100, 200, 300, and so on. For every 100 stocks, we must create one contract. So the contracts that we create is what pays us an income. I'm going to look at a stock that we've got today, but I'm not going to actually give you the stock code right at the moment. The stock at the moment is at $22.78. So what we would need to do is go into the market and acquire these shares and invest $22.78 per share. We need a minimum of 100. So times that by 100, our minimum investment is going to be $2,278. So do you have $2,278 right now sitting in your bank account? Most people do. What's it earning you right now? Have a look at the result and the returns that we're just about to generate on this. What we're going to do is we're going to create a contract. The contract that we create is at $23. And what that contract says is this. We are purchasing a stock today at $22.78, thereabouts. And we agree that at a future date, being the third Friday of this month, in February, because now we're into February contracts, that on the third Friday in February, we agree that if this stock goes at or above this particular price, we are happy to hand our stock over and convert our stock or shares into cash. So we hand the stock over and we get the cash value back of $23. So at the end of the third Friday, if this stock closes at 26, we're agreeing to get back 23. Now the person who purchases our contract that we create on the stock market agrees to pay us right now an income of $1.55. So understand this, there's two sides to the stock market. There is a buyer and there is a creator. What we actually do on the stock market is we create the stock market to allow the buyer or the trader or the speculator to trade the market and speculate on the market in the hope that the market goes up. So allow me to ask you a question. Would you prefer to speculate on the stock market, putting money into the market, waiting for the market to move in a particular direction to earn an income in the hope with no guarantee of a return? Or would you prefer to create the stock market as we do with Fokas Beyond, where we earn an income up front banked into our account irrespective of whether the stock market's going to go up, down or sideways today, tomorrow, next week or next month? But folks, don't take my word for it. Here are some of my students with real money live in the markets and what they're earning right now. See for yourself.